Realty Income Corp., known as the Monthly Dividend Company, is one of the highest quality real estate investment trusts in the country. The company is A- rated, has 39.55% debt to capital, and as you can see by the fast graph, using funds from operations as a valuation reference, the orange line on this graph, it has been very rare in recent years to find this company trading at an attractive valuation. But rising interest rates have changed that, and for the first time, really in about 7 or 8 years or more, Realty Income can be purchased at an attractive valuation, offering a 5.15% dividend yield. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. And this video is going to talk about Realty Income, the monthly dividend income real estate investment trust, one of the highest quality REITs you can buy. And it's very rare that I'm able to talk about this REIT because as much as I've liked this REIT from a standpoint of providing stability and safety of income, as well as a little bit of growth of income, as well as a little bit of high yield, it's been very, very rare to be able to buy the stock at a valuation that allowed those attributes to be harvested by the investor. So I'm very excited to be able to talk about Realty Income now. This is oriented to the income investor who's looking for safety, good high level of income, some dividend growth, and some moderate capital appreciation along with it. Anyway, let's go ahead and look at the fast graphs, and we're going to go through this by the numbers. Now, I'm going to take the graph apart a little bit because I want people to understand what I'm showing you here. What we're looking at is funds from operations, okay, which is essentially cash flow for REITs. And the dividend is obviously the dividend payout ratio you can see is an 80 or 90%. That's the white line is the dividend per share. And the dividend payout ratio is very, very high here because the one thing about the real estate investment trust, it pays out most of its income, all of its distributable, 90% of its distributable income to be precise, to their shareholders. And so, it's not just a high yield, but it's a high return. Investors in a REIT like this get to participate fully in the income generation of the asset. And I think that's very important. Now, there's another aspect. I'm going to put weekly closing stock prices on this graph. And I want to point a couple of things out. Back in the beginning, when this graph was first produced, back in January 9th of 2004, Realty Income was trading at a price to FFO of 13.69, so it was just modestly undervalued. Today, it's trading at a blended price to FFO of 14.63, approximately the same, just a little bit higher. And the point I want to make here is that I'm measuring this now as I like to really measure any investment, and that's with fundamentals calibrated. In other words, it was in value when this graph started, and it's currently in value now. So one of the attributes that you find when you buy value investments, especially if you're buying them at fair value is a point in valuation that allows you to fully participate in the business. So when you're buying a company at its fair value or intrinsic value or true worth, as we like to say, that puts you in a position at a modest level of risk to fully participate in all the growth. Now, the company's a moderate grower, grows at 5.38% funds from operations over time. But if I look at the performance report here during this period of time, I discovered that capital appreciation has averaged 6% a year. Now, by the way, that's a little less than what the stock market, as measured by the SPDR ETF, has done, but it's consistent with approximately the same as the overall market. But where Realty Income really shines is the fact that it generated $20,000. This is on a $10,000 investment made on January 2nd, 2004, and held to yesterday's price. A simple $10,000 investment would have thrown off over $20,000 or 2 times your original investment in income. And notice the growth. First year, you'd have got $620 worth of income, then $673. And as you follow my mouse here, you can see how that income has steadily grown over the years. And in 2022, it generated over $1,531 on a $10,000 investment. That's a 15.3%. I call it growth yield. Some of you call it yield on cost. This is the real advantage of owning a REIT like this. In other words, the average stock, as measured by the S&P, would have thrown off $6,400 plus in income. Realty Income threw off over 20,000. That gave it an advantage of an 8.8% annualized compound growth versus only 7.71, and that's without dividends reinvested. Now, with fast graphs, one of the advantages of fast graphs is that you can look at it from both ways. Okay, you can actually reinvest dividends, and you can, measure this performance by reinvesting dividends. And so when you do that, you'll notice that the end of period shares changes. And when you reinvested the dividend, the advantage of a company like Realty Income, if you don't need the income, turns out to be significantly greater. $10,000 investment generated almost 4 times your original investment, $38,333 versus only $8,000 if you invested in the market. That would have turned $10,000 cumulatively into $82,000 versus only $50,000 in the market. So, it's a company that can generate high rates of return, above average rates of return, I should say, if you're an investor looking for total return, but it primarily did that through the generation of income, because otherwise it was in a dead heat with the market. Another thing I want to point out is the fact that the company pays monthly income. And if you click on the drop down here, you can see the monthly dividend checks. That's very nice for certain, investors who are retired, for example, who are looking for that monthly income. And they just raised their dividend, I think, by 2 or 3% about the middle of March 14th, I think it was, about a week or so ago. Dividend growth rate going back now to this time frame since 2004 has averaged about 5.23%, and the compound growth rate's been 5.14. Their lifetime average has been about 4.5%, and I'll show you that here a little bit later. So from a standpoint of being a long-term income-oriented investor, I think this is an extremely attractive opportunity. And again, the opportunity comes from the fact that you'll notice that the market has been putting a premium valuation on this stock, especially since coming out of the Great Recession. But I also want to point out this is during a period of time when interest rates were extremely low. All right, so the market kept putting a premium valuation. Now, when the market was valuing Realty Income like they were here at, say 25 times FFO, I still like the company as much as I do today. Now, even if you'd have bought it then and held it to today when it became fairly valued, you'd have still averaged about 5% a year. You got a little bit of growth, averaging about 1% a year. But you would have still made a decent, not necessarily decent, but you still would have made a positive return on your investment. So, this is an extremely high quality company, but I want you to note that from an annualized rate of return, if you bought it when it's trading at fair value, your rate of return balloons to almost 10%, almost double the number. So valuation matters, as I always say, and matters a lot. And now because of rising interest rates, Realty Income has come down to a price to FFO below 15. It has an FFO yield of 6.8%, which meets my normal criteria. And so I consider the stock attractively valued. Now, growth going forward is an issue, and I do want to relate to that. Growth is expected to average about 3.5% going forward, and that would indicate about a 9.25% rate of return, including dividend income. The normal multiple, which has been over 20 times FFO, would give you a much higher rate of return. But I don't think that's realistic now because, again, this high valuation that we saw here coming out of the Great Recession, the recession of 08 and 09, is functionally related to interest rates. And interest rates are going to be are going up now. The Fed just raised it by a quarter yesterday, and that's part of what brought this down, as well as a lot of other REITs and a lot of income investments. But I think the long-term future for Realty Income is still intact. Now, Morningstar, in their most recent research and strategy and outlook, talked about some of the benefits of investing in Realty Income. They point out that it's the largest triple net lease REIT in the United States. That's very important, being a triple net lease REIT. They have more than 12,000 properties that mainly house retail tenants, and I'll show you that here in a minute. The company describes itself as the monthly income company, which I already talked about. They pay dividends monthly, and its line of business and operating metrics makes its dividend one of the most stable sources of income for investors, as I illustrated clearly when I went through the performance report. Now, even though over 80% of their tenants are in retail, Morningstar points out that most are focused on defensive segments with characteristics such as being service-oriented, naturally protected against e-commerce or resistant economic downturns. So there's a very conservative element to investing in Realty Income. And this triple net lease structure places the burden of all operational risk and cost on the tenant and requires the tenant to make capital expenditures to maintain the property rather than the landlord. And Realty Income generally works in long-term leases. Now, Zacks has similar, discussions. Zacks broke down a little bit more kind of the nature of Realty Income's properties. Their portfolio, according to Zacks, has 11,733 properties, aggregating over 225.7 million square feet of leasable space, located in all 50 U.S. states, Puerto Rico, the United Kingdom, and Spain. Okay, so it does have some geographic diversity. And, these properties are further leased to tenants among 79 different separate industries. So again, they've got a lot of diversification. As of September, according to Zacks, 93% of their annualized retail contractual revenues were derived from its clients with a service, non-discretionary or low price component to their business. Also, their retail properties generated 84.6% of revenues, while industrial 13.9%, and other assets the remaining 1.5%. Now, there are some real strong reasons to buy that Zacks gives Realty Income, in addition to the fact that it's now fairly valued, that it's a well-diversified portfolio with regards to their tenants, their industries, and their geography. They have 93% of their annualized retail contractual revenues from tenants with a service, as I already mentioned, are major industries representing 33%, grocery stores represent 10%, convenience stores 9%, dollar stores just under 8%, and drug stores 6.2%. Now, most of their properties are freestanding properties. So let's go ahead and go into the company a little bit and just give you some color. One of the advantages of fast graphs, you go into these external links and go into the company's corporate website, and you can learn about the company. Okay, and they go who we are. Well, at a glance, they have a compounded annual return since 1994 New York Stock Exchange listing of 14.6%, 4.4% annual compound dividend growth. As I showed you earlier, it's been a little bit higher over the last 20 years. They had 633 consecutive monthly dividends declared and over 11,700 properties under long-term net lease representatives. So I think that's very, very important. If you look through their portfolio and look at what they own and where they are, they have this strong geographical distribution, and they own companies like they're invested in companies like CVS and Home Depot and other companies like that. The company is, again, very well diversified. Let's go look at their portfolio very quickly again. And, you'll see that they own these triple net leases in, properties that basically are pretty much immune to some of the issues that a lot of retailers are facing nowadays. And I think that's very important. When they talk about what the company does, they have over 11,700 properties under long-term lease in 79 different industries I've already pointed out. They have a gross real estate book value of $39 billion and an A3 credit rating by Moody's and an A- rating by Standard & Poor's, which I pointed out on the fast graph. We use the Standard & Poor's data. Now, a couple other things I want to go through. I do want to also show AFFO, or adjusted funds from operations, not as universally calculated as FFO, but the company looks also very attractive based on price to FFO. Again, I want to reiterate, rarely do you have a chance to buy this company at an attractive value, and rarely do you have a chance to buy it with a dividend yield in excess of 5%. Looking at other cash flow related metrics when I'm looking at Realty Income, let's go ahead and look at EBIDTA. From a price to EBITDA, the stock looks fairly valued and reasonably attractive. The normal price to EBITDA is 13.16. It currently trades at 12.71 times EBITDA, so that's just a little under its long-term norm. And then if you look at price to sales, it's trading at a price to sales of about 10.8, and it usually trades at about, its average price to sales historically has been 10.9. And I want you to look again. You can see this idea that when the price to sales gets below that, like it did during the Great Recession, it did get down to about 5 times sales, but then immediately, or within very quick time, maybe 1 or 2 years at the most, went back to the 10 times sales. Likewise, when it gets over 10 times sales. Like here we have 16, 15, 16 times sales. It reverts to the mean. It was very highly exposed during COVID. As you can see that, we had this flash crash, but look how quickly it recovered. And this is the thing, I'm getting a lot of this with, people talk about value investing. If you were a value investor, for example, during the Great Recession, and you bought the stock here when it was trading at 9 times sales, let's say, or 8.19 times sales, within a matter of just a very short period of time, you'd have lost over 35% of your money, and that would have been an annualized rate of return of minus 58%. So that would have been very negative. But if you look at it from the standpoint of holding on to it for a year or so when the fundamentals remained strong, you'd have ended up making over 20% a year, even though you had to suffer through some downside. Stock prices don't matter as much as fundamentals matter. I've said that so many times. And, I trust what the business is worth more than I trust what a very fickle stock market may be pricing it at. As Warren Buffett says, you want to be greedy when others are fearful, and fearful when others are greedy. And that really applies to this particular real estate investment trust. When it was extremely cheap, that's when you wanted to be greedy. When it was extremely expensive, that's when you wanted to be fearful. Because even here, that's by buying it at a high valuation, you drop your rate of return to 2%. But what's interesting, even in this example that I'm showing you here, the dividend, the strength of the dividend actually gave you a positive rate of return because your market value dropped to $8,946 on a $10,000 investment, but you got $2,600 in dividends, which allowed you to eke out a rate of return. So even if you bought this stock at a very poor valuation, you still would have ended up making money in the long run. Now, a couple other things I just want to go through. I want to go through a little bit of the financials and just take a quick look. I'm going to use our fiscal fitness section here in Fast Graphs. The free cash flow covers the dividend, and that's really FFO or AFFO, actually, free cash flow. Their operating cash flow growth has been stellar. It's grown at over 4%. We talked about share buybacks, we call it, are important because all I want you to notice is this company's been generally issuing shares, and they've been issuing shares in a market when the value of their stock was actually trading at a very high level. Okay, so let's go ahead and look at that just to be clear. They were issuing shares when their stock was trading at these premium valuations. I consider that, that was a positive. Now they're facing much higher interest rates coming up. I don't think they're going to be able to do that. Their sales revenue growth I've shown you has been stellar. Their margins and returns on capital and so on have been really good relative to the industry. So here you have it. That's about, what I wanted to share with you today. I really like this REIT. I think it's one of the best real estate investment trusts in the world, if not in the country, if not the world. It usually trades at very high valuations relative to its, distributable cash flow, as you can see by the fast graph here, looking at FFO or AFFO, and by either standard, the stock, is trading at one of its, best valuations you've seen in years, excluding COVID, and it did get relatively cheap in January of 2014. But once again, when you can buy it at, in this case, it was a little higher than it is currently. But if you participate, you still ended up making over 9%, and you got over $6,000 in dividends on a $10,000 investment. This really is all about the income with a little bit of a capital appreciation kicker. Now, we're coming up into a period where we're going to have rising interest rates. We don't know how long that's going to last. That's going to make it tougher for this company, but with a pristine balance sheet, the company has an awful lot of liquidity. They have the ability to raise capital and borrow money, and they are, going to continue to make acquisitions to generate more distributable income. I think it's a great time to be buying this stock. But I do want to make a caution. If you look at what happened during the Great Recession, if we did hit a recession coming up, and there are a lot of prognosticators that believe we're going to be entering one probably pretty soon, and that's partially why this REIT is attractively valued. Don't be surprised if this REIT were to drop in value like it did in 2008 and 9. But I believe this particular company is so solid, so well diversified, and such a high quality income vehicle that if you did get that opportunity to see the price drop significantly below this orange line on this graph, that'd be a time you'd want to buy more. So this is for the income investor who's looking for quality, high yield, and an opportunity to, get long-term income that's increasing over time. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this. I didn't do a video last week. I had a tragedy in our family. So I wasn't able to do one. So I thought I'd go ahead and give you a bonus video this week. Hope you enjoyed it. Realty Income is a real estate investment trust that I have very rarely had an opportunity to invest in. I'm looking at it right now for my income portfolios to add, as long as it stays attractively valued like it is right now. But anyway, I think it's a great opportunity. I hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to the channel, but also subscribe to FastGraphs if you aren't already. What a great tool to help you visualize the value of the businesses that you're looking to invest in if you're a long-term investor. It's not about the stock market. It's about buying great businesses at attractive valuations. And FastGraphs helps you do that better than anything out there. And by the way, I hope you guys are enjoying the international stocks and playing with those. I'm learning about those just as you are, and haven't done any international videos or reviews yet, but I'm still trying to learn like all of you, I'm sure are. Anyway, thanks for watching. Talk to you again real soon. Thanks.